before there was all of this, there was this.
Welcome to Blockbuster Video.
But then Netflix changed everything. Once a DVD distributor,
it's easy.
It became a streaming pioneer, revolutionizing the way people watch TV and movies. Other networks and studios raced to catch up. And now Disney, HBO, and NBC are chipping away at Netflix's market. And in April 2022,
a report from Netflix saying it's lost subscribers for the first time in a decade.
That was enough to send its stock plummeting 35% in a single day, Netflix's worst day since 2004. And though the stock hasn't fully recovered, the company made gains in the third quarter, adding 2.4 million subscribers. So what happened to the streaming giant this year, and how is it bouncing back? Netflix lost 200,000 subscribers in the first quarter of 2022, instead of the 2.5 million it projected to gain. Netflix said that completely shutting down its service in Russia, following the country's attack on Ukraine, resulted in the net loss. The company also attributed the loss to increased subscriber churn. Part of that came from a price increase in January.
It wasn't the first time that Netflix had raised prices, but it was a price increase that triggered new sort of consumer defections.
Along with increased competition and inflation, it also had to contend with another problem: password sharing.
These are over 100 million households that already are choosing to view Netflix. They love the service. We just got to get paid, in some degree for them.
So the streamer moved to make a change.
We're not trying to shut down that sharing, but we're going to ask you to pay a bit more to be able to share.
And that wasn't all. As the company tried to control costs, it laid off more than 450 people over the next few months.
The stock decline triggered a series of changes that the company is still enacting. So one of the biggest changes that came after that decline that was announced that same day was that Netflix would add an ad-supported tier of service.
But those changes are an about face for the streamer, which has famously eschewed ads and embraced sharing.
Those who have followed Netflix know that I've been against the complexity of advertising and a big fan of the simplicity of subscription.
That simplicity worked in the company's favor at a time when growing was the goal.
In the early days of the rise of streaming and really the streaming wars, what helped convince consumers to cut their cable bill was that Netflix was flexible and you could binge series whenever you wanted. You weren't encumbered with ads in the same way that you were on cable, and you could share what you paid for with family and friends.
And in 2020, that model really worked, especially during the pandemic. The company's vast content library and bingeable series drew in customers confined to their homes. The streamer's share price rose from $319 in March of 2020 to over $550 in early 2021. It also added a record 37 million new users in 2020 on the strength of popular shows like The Queen's Gambit, Tiger King,
My name's Joe Exotic and this is Sarge.
and Bridgerton.
I wish to be entertained.
There's a subset of companies that benefited intensely from the pandemic and the way people's lives changed during it. And a commonality that you see in those companies is that when times are good, it's very hard to imagine times becoming bad again.
But things did get bad as the pandemic wore on and people started to leave their homes. In 2021, the company's growth began to slow.
COVID created a lot of noise and how to read the situation, boosted us a lot in 2020. And then in 2021, I think we, thoughtfully said it was mostly pull forward, which was the logical conclusion. But now coming into 2022, that, doesn't really hold.
April wasn't the first time in 2022 that Netflix's stock sank. In January, after the company forecasted slower subscriber growth, shares fell 20% in after-hours trading.
In the streaming business, the number of subscribers that are paying you to watch your content is really one of the most important metrics of a company's health.
But while streaming services like Disney Plus or HBO Max have other ways of generating revenue,
Netflix almost entirely is in the business of streaming, and so that is its lifeblood, and when it loses streaming subscribers, that is a problem for the heart of its business.
And with a crowded field of streamers, gaining new subscribers can be difficult.
The challenge that all the streaming companies are having now, particularly in the US, is they have acquired most of the customers that are ever going to pay to stream. They have to figure out how to make more money from those people. Then what that puts front and center for all of these services is the importance of competing on content.
After April's stock decline, the company scrambled to act quickly.
There have been rivals that have been in the business of selling ad-supported tiers for quite some time. There have been other streaming services, Spotify for one, that has always been very stringent about password sharing. So these are levers that existed before that Netflix hadn't pulled. And so I think that moment sort of raises the question of, was Netflix too slow to do all that it could have to avoid the severity of this moment?
This year, Netflix's share price is down more than 60%. But the streamer reported something of a turnaround in the September quarter. The company added twice as many subscribers as expected in Q3, sending shares up in after-hours trading immediately after its report.
Thank God we're done with shrinking quarters. Everything the company's focused on, whether that's on the content side, on marketing, lowering prices to the ad-supported, the paid sharing, the thoughtful approach we're doing there lines us up for a good next year.
Looking ahead, the streamer says its new ad-supported tier will launch in November for $6.99 a month. And the company this week laid out some of the steps it will take to crack down on password sharing and make it easier for subscribers sharing accounts to make their own.
Those are the two strategic elements that it really needs to nail at this point, because those will prove to shareholders whether or not the promises and decisions that executives have made are going to bear fruit and set the company on a more sustainable path in the future.